We're getting ready to start. Camera one, camera two, camera one, camera two. And hello, South Florida, and the rest of the real estate world out there listening to us on any of the 5 different ways that you can listen to the Real Estate Show. My name is Eric Willner, and we are here again live at 5 p.m. for the Real Estate South Florida's #1 program about real estate and America's longest running daily radio show, all about the topic of real estate. We are here talking about real estate 5 days a week, live at 5, and then rebroadcast our entire binge watch us at 9 on Sunday. So 5 days during the week, 1 show a day, your daily dose of real. Sunday night, get your mega dose and catch yourself up for the week on what we've been talking about. And this week, what we have been talking about is what is more important. Is it the credit or is it equity when it comes to owning real estate? And so we've been conducting this poll, and appreciate all of you that sent in your answers to the poll. I said that at the end of the week, we will tally that up. And that is where we'll spend next week entirely on that subject. So each day of the week this week, kind of to change it up a little bit, I've been talking about one article and one topic about credit in the first half, and then one article or one topic about equity in the second half, and sort of to change it up. I did last 2 days I did equity first and credit second. Today I'm going to talk a little bit about credit first and equity second. But if you want to participate in our poll, if you want to learn more about either one of those topics, put in your vote. All you have to do is text the word credit if credit is your biggest vote, or if you vote for equity, text the word equity, either one, to 561-861-2366. Just having a little fun there. That's 561-82366. So we've been talking about low interest rates as we've had it. There you go. Susanna just put credit there up on Facebook feed. By the way, remember, you can listen to us on the radio on the AM dial 1470, on the FM dial at 96.9 or 95.3. You can take us with you on the go wherever you are. If you have a cell phone or a connected smart device, all you have to do is download one of the free radio apps like the TuneIn, iHeartRadio app, the radio.com app, just to name a few. Even WWNN, our station, has their own free app that you can download, click on it, and you're connected to the station all day long. Lots of great financial information, but I'll tell you, live at 5 is where it's at. And so you can also listen to our live streaming on automaticlandlord.com. That's automaticlandlord.com, brand new redone website, kind of really nice. If you haven't seen it, come check us out. And as we just mentioned, our Facebook page. So latest thing, we've seen that the average rates for mortgages right now remain at not 5-year lows, not 10-year lows, but at all-time lows. We're right there, bouncing around at that 3%, And if you want to know how, and that's kind of sort of my little bonus. If you vote credit for next week and we talk about credit, I'm going to show you how to take a 3% fixed mortgage for 30 years and drop the rate even further. That's only if you vote credit. Now, if you vote equity, don't worry, I got good stuff for you as well. But the window for refinancing remains open. So if your interest rate is above, if it's at 4% or above 4%, it may seriously make sense. Now, if you're at 3%, I'm going to show you a very cool technique next week. Again, depends on whether we go equity first or credit second. But don't worry, I'll be letting out this set. In fact, if you want me to tell you about what that is, just text the word credit, because I'll show you how that works. But the fact of the matter is that we are in a great credit situation right now. Lenders have lots of money to give, and there's a couple of reasons why we're seeing that happen. What's number one? Number one is a lot of people who have refinanced to these low rates already have and therefore there's not much more for them to go unless interest rates go down to 2% or below, which I doubt. But there is the savings. Now, if you're looking to get additional cash out or to do a debt consolidation, this might be a very interesting time, and you can and reach out and we can let you know. And we'll do a numerical financial analysis and show you, because this is not about, I'd like to, or I think I should, or what I should. How about getting the numbers so that you know exactly what you need to do? And for a bonus on that, I will go ahead and show you how to lower the interest rate that you already have. And that's why in some cases, don't even have to do it. Don't even have to go through the expensive cost of a refinance. For about half the price of a refinance, I'll show you a technique that will save as much and maybe more money than the refinance. But what the experts are saying right now, which is kind of interesting, is that mortgage rate hit a bit of a snag, if you will, a bump, and the average rate, which now ticked up a whole 0.02% from 3.03% last week to 3.05 this week. And that's according to Bankrate's weekly survey of large lenders. So they've surveyed a whole bunch of them. For homeowners, the biggest takeaway is that the mortgage rates are hovering near their all-time bottom since early this year. A year ago, by the way, the benchmark, the most common 30-year fixed rate mortgage was 3.11, and we just rose from 3.03 to 3.05, still significantly below that 3.11, and below the 52-week high. So in the last 52 weeks, 12 months or 1 year, however you want to call it, the high of the rates was 3.34. So we're down literally, a significant 10% off of this year's high. And so the 30-year now had an average across the country, and this is good stuff to know, by the way, an average of 0.37 discount or origination points. And if we talk about credit next week, I'm going to talk a little bit about points and discount points, origination fees, and what you should look for on these closing statements so that you understand how that all factors into the overall APR. And this is something that I see very rarely does it get explained. Most people couldn't tell you. Ask somebody, how do you figure out why is the APR different than the interest rate? And some people, you're probably out there saying, what is an APR? And that's the annual percentage rate. And then there's the APY, the annual percentage yield. Again, I'll save that for our next topic. But interesting to know, the 15-year fixed, which is always, I should never say always, almost always lower than the 30-year. Right now, the 15-year, you can get it for 2.37%. Now that may make sense, because if you can refinance from a 30-year to a 15-year and not increase your payment because the rate came down so much, well, then you just gained 15 years towards your payoff, and that might. And the reason I say might is because as an investor, there are times where there are other benefits of keeping a 30-year mortgage may be better in that situation. Now, we haven't talked a lot about this, and I don't hear people talk much about this, but there's another version of the 30-year mortgage, which is known as a 5/1 ARM. Okay, and it's a 5/1 adjustable rate mortgage, which now fell to 3.19%. And you have to watch this rate, because what a 5/1, if you've ever seen a 3/1, a 5/1, a 7/1, I've even seen a 9/1 and a 10/1. And what those are, that means that it's fixed for that first number, 3, 5, 7, 9, 10, and then it becomes an adjustable rate. Now, if you're betting that the interest rates are going to go down, an adjustable rate could be very interesting. Or if you're betting that you're not going to be in the property 3, 5, 7, 9, 10 years from now, this becomes a very interesting, because usually that fixed rate mortgage, but is what you see right now is we have a little bit of an inverted yield curve, because if I can get a fixed, never changes, at 3.03 and the 5-1 is 3.19, the 5-1 is not a good choice in any of the cases. But oftentimes, these are little ways that, if you have an investment property that I want to buy and I'm going to hold it for 5 years, and then I plan to sell it and do something else or retire something else, then these are really cool options. The 30-year fixed jumbo, bigger loan, and no, there's not an economy of scale or discount or a bigger mortgage. The way the lenders look at it, it's more eggs in one basket. So the jumbo rates, which are often, a quarter to 0.5% higher, right now are going at about 3.21%. That's a great rate for a jumbo loan. If you're looking for, a loan that's over $500,000, give or take, then you ought to be looking at this market right now. So where mortgage is headed is probably the next big question on your mind. And everything that I read across the board, mortgage experts are confused. I should say they're mixed about the future direction of the mortgage rates. Another survey, also by Bankrate, 45% of those that responded to their survey predict that rates will stay the same in the coming weeks. 36% say they'll rise further, and but only about 18%, less than 20%, predict that there's a decrease. And if you're a regular listener here at the radio show, you know about my conversation about the concept of interest rate compression. And that's why I think there's a resistance for it to go too much lower. Few things about the post-COVID economy that have turned out to be quite unexpected. The mortgage market continues to defy all predictions. So, it's like the three-handed economist. On the one hand, he thinks it's going to go up. On the other hand, he thinks it's going to go down. And then on the third hand, well, who knows, or it's going to stay the same. But what we're starting to see, that slow but sure climb. I mean, we're really experiencing the lowest rates ever in 30-year mortgage history. And so now the question is, if there is a resurgence in the COVID, because you hear about the Delta variant, and then now you hear about the Mu, which may even be vaccine resistant. Makes you wonder about what was getting in line for that vaccine. But the chaos going on in Afghanistan is adding to all that, and so you've got this little background noise wrinkle, and oftentimes uncertainty in the marketplace causes interest rates to rise. But so far, all of the economic data here has been mixed. We've seen a little bit slower job growth. And that's probably part due to the resurgence, even though I see nothing but help wanted signs, and I hear nothing but stories of businesses. The other day I went to a restaurant that had to close early because they didn't have enough employees. We were down at a resort, and they closed the bar down because the employee didn't show up. I hear nothing but the trades, the plumbers and the electricians and all those folks not being able to get workers to do the jobs. There's work to be done, but no workers to do it. So we expect, hopefully, further improvements that could lead to the Feds influencing the rates to stay at least till the end of the year around where they are, which if that happens, then we can expect to see the rates. Wow, this is incredible. So anyway, what we're going to do here is take a quick break, hear a few words from our sponsor. When we come back, we'll shift gears and start talking about the equity side of the picture, and then we'll finish up our poll, and then tomorrow we'll talk a little bit about the results of the poll and a little bit about what we talked about for the past week, and give you a sneak preview of what we'll be talking about in the coming week. But the bottom line, if you haven't already, refinances are a great deal right now, especially with rates this low. So don't touch the dial. You're listening to The Real Estate Show. My name is Eric Willner, and I will be right back. How you doing, Susanna? How are you? Second half is actually going to be really fun. This is an article which I thought was very interesting. And again, not hearing much conversation about it. You hear about all the frenzy, but you don't hear about the data and everything that comes with it. So we will go ahead and some flour. Don't tell me they couldn't deliver it. Let's see. Call let me know that they couldn't fulfill because the florist in that area had someone call out sick, and a second florist requested to fill. We're putting flour. That is interesting, and I'm seeing stuff that you never would have imagined something like that. And like I said, in a full-on resort scenario, they can't even provide the some of the services there. I remember when the COVID first started, they weren't doing, for sanitary reasons, they were not having the maids clean the rooms or interact with the guests. That has resumed, but they're still short-staffed. We're going to come back now. And welcome back. For those of you who might just be joining us, you are listening to The Real Estate Show, South Florida's #1 program about real estate, America's longest running daily radio show about real estate. And for those of you just joining us, we have been conducting a sort of an informal, formal poll. What do you think? We started off the week on Monday talking about, the major considerations when it comes to the acquisition of a mortgage. In other words, qualifying for a mortgage. There's three main factors, and that really relates. I could say the same thing about buying a house. There's three main factors that determine whether you can or what you can buy. Right. Number one is how much down payment you have, and I would call that, how much equity are you putting into the purchase? What are you bringing to the table to motivate a seller to sell and a lender to lend? That's number one. Number two is the amount of credit that you are able to sustain. So, a good credit score, income, and what that part of the equation. So you've got the equity that you bring to the table, the credit or the loan that you bring to the table, and then finally is the income piece, which is your ability to sustain all of that. So today we wanted to look at those two. We were having a competition this week. What's more important, or what's harder for you right now? What's more of a challenge for you that you would want to learn more about? So if you think that it's credit, then I invited you to text the word credit, our smart line, 561-861-2366. If the equity or down payment part is the bigger challenge, then text the word equity. And depending on who wins that vote there, next week we're going to spend time in that arena. And I've got new stuff, really interesting, cutting edge stuff. There's a new loan program that just came out for people who are in forbearance programs. Remember, before, forbearance was basically the kiss of death on getting a new mortgage. Now there's a brand new program that just came out, and it is sort of a reopening of an Obama era program. In fact, a Bush era program called HARP, the Home Affordable Refinancing Program, which was for people that were in a distressed situation. So now we have a program for that. So I always say that if you don't own a home, it's probably because you don't want to. If you seriously want to, then number one, cast a vote because we want to know the poll. Number two, that puts you in line, get some free information automatically sent to you about either credit or equity, and then we can have a conversation. You can continue that thread of what you get. So don't worry about people calling you, chasing you down, or hounding you. That's not going to happen from here. Now, on the equity side of this conversation is a very interesting article that I read. It's called "The End of Forbearance Programs Won't Months." Yes, there will be a spike in some foreclosures, but will there be a market crash? The answer from here has been no. In fact, I've been talking about the so-called, gurus out there, the forbearance, or I should say the foreclosure kings of educational material, have been saying there's a foreclosure tsunami or the foreclosure tidal wave and all of this stuff, and all that did was sell a bunch of courses. Estate investors, because everybody in that arena has been waiting on the sidelines. And if you've only been waiting on the sidelines, have you been wasting a lot of time? Because if you're living off of sound bites and realtor outs, then you've been missing the boat altogether. I've been talking about, I spent a whole week last week talking about it. But 1 year ago this month, I read an article and there was an interesting term called a foreclosure crash brothers, or foreclosure clash, say that 5 times fast, the foreclosure crash bros. And it was one of my pet peeves when somebody goes, "Hey bro," an updated name for the housing bubble boys, another interesting name, who never got their housing crash that they promised us buy my course. And when the housing crash happens in the early COVID, oh, no, it's going to be in the mid COVID. Oh, no, it's going to be at the end of the later COVID. It's going to be at the end of the year. Oh, no, now it's going to be in 2021. And last I checked, yes, it is September of 2021 and still no crash. Now they're starting to change their tune and they're moving it to 2022. Interesting, isn't it? So they keep moving that thing. Right, even a broken clock is right twice a day. Now that we're in the month of September 21, we can safely say the housing market crash has been moved once again to next year. And so let's take a little bit of a look back, but let's also not forget that hunkering down in the deep dark well of unknowns during the early days was a scary time, regardless of how much toilet paper you stockpiled, or canned chili, or wipes that you end up buying. The bottom line is all of that stuff did not happen. And all what we have seen, in fact, is something very different. We've seen a real estate market that has just gone, crazy forward. We've seen a real estate market that continues to have no inventory. We've seen a real estate market that still has a continued fight for more and more. So here it is, an opportunity. Anybody who bought property, right? Those people who bought property now have a lot more equity. And that is what is going to be, I think, the story for 2021. And I would not be surprised, and if you've been listening to the show on a regular basis, is that you're probably going to see this go past 2022 between the millennials and their demographics, between the lack of construction for 10 years after the 2008. And we're only starting to see construction, and definitely not enough in the areas that there's needed most, in the affordable housing arena. Most of the construction that we have seen has been in the $5,000, $6,000, $7,000, $8,000 range, and we've seen the demand has been strong there. So the builders can make 10% on 600,000 or 10% on 200,000. They're going to build the $600,000 all day long. And then when you had the cost of lumber and other construction materials go up a lot, that was a further nail in the coffin for affordable housing. And as I said, probably the biggest hurdle we're going to be seeing right now, again, here's an situation, is in the construction of more inventory, because a lot of the folks who might even consider selling right now are going to say, well, then where will I go? If I sell, I'm going to have to pay more for what I want anyway. I might as well just keep what I've got. So interesting article that I'm saving for next week. Manufactured housing may be the key to affordable home ownership. And I got a couple of other ideas, which I'm going to use if you vote equity. So which one are you going to vote? Equity or credit? Either way, text either one of those words, equity or credit, to 561-861-2366. Once again, that's 561-861-2366. No charge on our part. If your carrier has a charge for texting, then just go ahead and send us a message at automaticlandlord.com. You can go there, automaticlandlord.com, place your vote there, or vote in the comments on our Facebook page at facebook.com/The Real Estate Show. Well, that's it for me for today. That's our About the Money segment of The Real Estate Show for today. That's Thursday, over and out. Until tomorrow for our Friday TGIF edition, this is Eric Willner signing off. Drive safe, wash those hands, and make it a great day. Bye-bye. We'll see you tomorrow. And somehow 30 minutes went by so fast. So fast. So fast. Goodbye. Bye-bye.